By the end of 2025, gold prices have stabilized around $4,229 per ounce. However, forecasts for 2026 from major analysts like JP Morgan and ANZ project a range of $4,500 to $5,000, driven mainly by expected Federal Reserve rate cuts and continued central bank gold buying. Gold's 20-year performance has outpaced the S&P 500, delivering a 543% return compared to the S&P's 482%, especially shining during economic slowdowns where it consistently provides positive returns. In 2026, the U.S. stock market is expected to benefit from 2.5% GDP growth and lower interest rates. Key outperformers will likely include tech, healthcare, and small-cap sectors. Still, market volatility keeps gold an attractive hedge for investors. Investors are increasingly balancing their portfolios by allocating 10-15% to gold, especially as the S&P 500 to gold ratio continues to tighten, signaling rising economic caution. Strategically, gold remains a strong long-term holding, while stocks offer better short-term growth potential. A weaker U.S. dollar and rising geopolitical tensions further strengthen the outlook for gold. American investors are increasing their exposure to both gold ETFs and physical gold, while simultaneously focusing on sector rotation within the stock market. By late 2025, U.S. investors are generally allocating 10 to 20% of their portfolios to gold as protection against stock market volatility, especially with the falling S&P 500 to gold ratio. Gold's low correlation with equities makes it an ideal hedge, and during economic downturns, gold typically delivers 15 to 20% higher returns compared to stocks. For risk management, diversification is becoming crucial. Investors are reducing overexposure to tech and healthcare while adding small caps and value stocks to stabilize portfolios. While Fed rate cuts will support stocks, any resurgence in inflation will continue to strengthen gold. Popular strategies like mixing gold ETFs, GLD, with broad stock index funds, SPY, and rebalancing quarterly are helping investors target 8 to 12% annual returns. Overall, accelerated central bank gold buying could push prices toward $4,500 in 2026, while stock performance will depend largely on maintaining 2.5% GDP growth. In 2025, U.S. gold prices had a strong global impact, especially on emerging markets. A weaker U.S. dollar kept gold stable around $4,229 per ounce, while aggressive central bank gold buying provided safe haven support to the U.S. economy. The S&P 500 gained 12.6%, boosting corporate earnings. Gold's 60% surge redirected significant global investment flows toward precious metals. Economic policies, especially the Federal Reserve's rate cuts, supported stock market growth while simultaneously strengthening gold's role as an inflation hedge, with U.S. GDP holding steady at 2.5%. U.S. exporters benefited from gold-linked pricing advantages, while the stock market helped drive job creation. Meanwhile, rising global geopolitical tensions pushed investors toward gold, and sector rotation within equities favored healthcare, which climbed 15%. Looking ahead to 2026, gold could reach $4,500, while stock performance will depend heavily on GDP trends and monetary policy. U.S. central bank gold purchases hit record levels in 2025 as the Federal Reserve and other institutions expanded their strategic reserves. This buildup helped keep gold strong near the $4,229 level and supported broader financial stability. These purchases enhanced confidence in the U.S. dollar and indirectly supported the stock market, since robust gold reserves reinforce global trust in U.S. financial leadership. Although the S&P 500 rose 12.6%, central bank activity boosted gold to a 60% annual return, outperforming equities significantly. This balance between gold and stocks helped support the 2.5% GDP growth rate, with gold acting as a hedge against equity market volatility. Forecasts for 2026 suggest that rising central bank demand could push gold toward $4,500, while stocks will remain sensitive to Federal Reserve policy decisions. Investors are closely monitoring these dynamics and adjusting their portfolios accordingly. U.S. traders are increasingly using advanced technical analysis tools in the gold market, with platforms like TradingView, MetaTrader 5, and Thinkorswim gaining popularity. Indicators such as RSI, MACD, and Bollinger Bands are signaling a potential breakout near the $4,229 gold level. These platforms provide real-time charting, volume indicators, and automated alerts, helping traders manage gold's rising volatility more effectively. In stock trading, tools like Bloomberg Terminal and Yahoo Finance Advanced track the S&P 500's 12.6% growth, offering sector heat maps, earnings calendars, and detailed analytics. Gold traders use these tools to analyze dollar index correlations, while stock market analysis increasingly relies on AI-powered scanners to capture strong sector performance, including the tech sector's 15% returns. For 2026, backtesting tools are projecting a potential $4,500 target for gold, while ETF scanners highlight rotation strategies within stock portfolios. Free platforms like FinViz and StockCharts Pro remain highly popular among retail traders for their accessible screening tools. U.S. investors are rapidly increasing allocations to gold ETFs such as GLD and IAU, which delivered exposure to gold's 60% rise in 2025 at relatively low cost. These ETFs offer liquidity and are backed by physical gold. GLD delivered a 58% YTD return compared to 12.6% for the S&P 500 ETF, SPY. Stock index funds such as VOO and QQQ continue to capture tech-driven growth, but gold ETFs have proven to be stronger inflation hedges, especially during periods of Federal Reserve rate cuts. Gold ETFs carry an average expense ratio of about 0.40%, competitive with equity funds, while offering tax-efficient structures that attract retail investors. In 2026, gold ETFs are expected to remain focused on the $4,500 price target, while stock funds will depend on 2.5% GDP growth and ongoing sector rotation. A balanced hybrid portfolio with 15% allocated to gold ETFs is helping U.S. investors optimize risk-reward alongside their stock holdings. U.S. gold mining stocks such as Newmont and Barrick Gold benefited heavily from gold's 60% rally in 2025. Newmont delivered a 45% return, far outperforming the S&P 500's 12.6% gain. These miners amplify gold price movements through operating leverage, though they remain sensitive to production costs and geopolitical risks. Sector rotation within the stock market shifted capital from tech toward healthcare and small caps, with the Russell 2000 rising 1.9%. Investors often add 5 to 10% gold miner exposure to reduce portfolio volatility, especially while gold remains stable near $4,229. Looking ahead to 2026, mining stocks are expected to benefit further if gold reaches the projected $4,500 target, while broader equity performance will depend on maintaining 2.5% GDP growth. Dividend yields of 2 to 3%, combined with strong growth potential, make gold miners increasingly attractive. U.S. traders are also expanding their use of gold options, both calls and puts, with strike prices around $4,229, seeing higher premiums due to volatility. Gold options offer leveraged exposure to gold's 60% YTD rally, while stock options remain tied to the S&P 500's 12.6% growth. In the stock derivative space, SPX index options continue to capture sector rotation trends in tech and other areas. However, gold options have become more appealing as the weaker dollar and Federal Reserve rate cuts increase demand for safe haven assets. Implied volatility stands near 18% for gold versus 15% for the SPX, making gold options better suited for high-reward trades. For 2026, traders are using straddle strategies to target the potential $4,500 gold move, while covered calls remain popular in the stock market for boosting dividend income. Risk management using Greeks, especially delta and theta, is essential in both gold and equity option strategies. On U.S. commodity exchanges, gold futures contracts, GC, each representing 100 ounces, are trading near the $4,229 level, with margin requirements ranging from 10 to 15% and strong liquidity across sessions. Traders holding long positions are benefiting from expectations of Federal Reserve rate cuts, while short sellers are betting on volatility, leveraging gold's 60% YTD surge. In equity markets, stock futures such as the E-mini S&P 500 ES, with a 50x multiplier, capture the index's 12.6% growth, but gold futures remain more sensitive to a weaker U.S. dollar. In spread trading, long gold short silver remains a popular strategy, while equity traders often use the ES-NQ spread to track sector rotation. Forecasts for 2026 project gold futures approaching $4,500, while stock futures will depend on sustaining 2.5% GDP growth. For futures traders, rollover costs and contango conditions will be important considerations. Hedge funds are actively using these contracts to hedge and balance portfolio exposure. For U.S. investors, long-term capital gains tax on gold falls within the 0 to 20% bracket, while short-term gains are taxed up to 37%, similar to equities. However, physical gold is classified as a collectible and is subject to a 28% tax rate. Gold ETFs like GLD follow stock-style tax rules, making their 60% YTD gains more tax-efficient compared to the S&P 500's 12.6% rise. Stocks with qualified dividends are taxed at around 15%, while gold mining equities offer 2 to 3% dividend yields, providing additional tax advantages. Gold ETF holdings inside IRAs and 401ks grow tax-deferred, allowing investors to build hybrid portfolios that reduce overall tax liability. Going into 2026, with gold targeting $4,500, tax planning strategies such as loss harvesting will become increasingly important. Stock investors must also consider wash sale rules, while balanced gold stock portfolios allow smart investors to optimize gains and reduce exposure. American investors are actively using tax loss harvesting to optimize the balance between gold and equities as they navigate a shifting market environment.